SCHD, the Schwab U.S. Dividend Equity ETF, one of the most talked about and somehow most divisive ETFs on the internet. And I've never seen a boring ETF make so many people so angry. These are real comments from my videos. And just so you know, these are the nice ones. Dude, dividend growth is dead, not a good investment anymore. Yawn, underperforms the market massively. Young investors in SCHD don't understand math. Yeah, I hear it all. Dividend growth is collapsing. You're missing massive gains. It's only for retirees. The tax drag makes it pointless, and you should just buy the S&P 500 and move on. Here's what almost all of these arguments have in common. They're short-term thinking, dressed up as math, cherry-picked timeframes, missing context, and a misunderstanding what SCHD is actually built to do. So today, we're going myth by myth, 8 of the biggest claims about SCHD, and testing them against the full picture. No hype, no emotion, just clarity. Myths will be busted. Let's get into it. Myth number 1, dividend growth is dead. Yes, dividend growth slowed in 2025. That part is true, but slowing is not the same as dying. Dividends grow based on company earnings, and earnings move in cycles. Some years are strong, some are slower. That's normal. Now zoom out for a second. Over the last decade, SCHD has delivered roughly double-digit annual dividend growth overall, with year-to-year variations ranging from mid-single digits in slower years to well into the double digits in stronger periods, including roughly a 12% increase in 2024. But here's the part almost nobody talks about, and this is what separates SCHD from a random basket of dividend stocks. SCHD isn't hoping dividend growth continues. It's built to select for it. The fund screens for companies with long dividend histories, strong cash flow, and sustainable payout ratios, and it reconstitutes based on those quality metrics. When those underlying companies increase their payouts, that growth flows through the fund and shows up in your distributions as a shareholder. So a softer year isn't the strategy breaking, it's a normal cycle inside a structure designed to favor dividend growers. And just like growth-focused ETFs can have slower years or even down years, they're built for long-term expansion. Dividend growth strategies will have natural fluctuations too. The key is understanding what the strategy is designed to do over full market cycles. Slower does not mean dead. The dividend is dead myth is busted. Moving on to myth 2. But if you're new here, my name is Steve, and this channel is all about building real long-term wealth with ETFs and smart portfolio strategy. No hype, no get-rich-quick schemes. If that sounds like your style, consider subscribing. And quick curiosity, how many shares of SCHD do you currently own? Drop it in the comments. I read every one. Myth number 2, you're missing massive gains holding SCHD. This one comes with a highlight reel. Every time growth runs hot, someone shows up in the comments with a chart proving you're an idiot for owning SCHD. And during the AI surge, they weren't entirely wrong. Growth led aggressively. If you held SCHD through that stretch, you felt pressure. That's real, but markets rotate, and we're already seeing it so far in 2026. Right now, the people who spent 2 years telling you that you are missing gains, they're currently the ones missing gains. Markets have a funny way of doing that. Here's the reality most people ignore. The best portfolio is the one you can actually stick with. If volatility pushes you to panic sell in February, the upside you captured in January never mattered. Stability isn't boring. It's what keeps you in the game long enough for compounding to work. SCHD isn't designed to beat aggressive tech funds every single year. It's designed to own profitable, cash-generating businesses that hold up across full market environments. Different tools, different jobs, inside a diversified, serious portfolio. Myth busted. Myth number 3, SCHD is only for retirees. No, and this one keeps young investors on the sidelines unnecessarily. Retirees often use SCHD for income. Younger investors get something different, compounding. When dividends are reinvested, more shares create more dividends, which buy even more shares. Run that for 20 or 30 years and the math gets powerful. Now, allocation matters. A 25-year-old probably shouldn't be anywhere close to 100% in SCHD. But in my opinion, it probably shouldn't be 0 either. For many young investors, having a small starter allocation, something in the 10 to 15% range, can make a lot of sense. Not because you're chasing income today, but because you're building the habit early. There is real behavioral value in seeing your portfolio pay you dividends. Writing SCHD off entirely because you're young ignores both the compounding power and the behavioral advantage of dividend growth investing. Myth number 4, you should only own SCHD. This one comes up a lot inside dividend and SCHD communities, and like most extreme takes, it misses the bigger picture. SCHD is not a full portfolio. It is one component with a specific job. Most well-constructed portfolios include broad market exposure, growth exposure, and dividend or quality exposure. SCHD fills that third role. It does not replace a total market fund, and it definitely does not replace growth funds. And there's a real risk to ignoring this. SCHD is intentionally tilted towards sectors like energy, financials, industrials, and consumer staples. If you only own SCHD, you are underweight entire parts of the market, especially high-growth technology. That concentration risk is exactly why serious portfolios combine multiple exposures, not just one. No single ETF should be expected to do everything. That's not diversification. Myth busted. Myth number 5, SCHD is overrated. Let's look at what SCHD actually is, because most of the critics never have. And here's the thing that always gets me. Why does a boring dividend ETF generate this much attention year after year? If it were truly overrated, people would have stopped talking about it. They haven't. That tells you something. SCHD is rules-based. It screens for profitable companies with strong balance sheets and a history of growing dividends. It avoids extreme payout ratios and obvious yield traps. And it rebalances systematically, which quietly removes weaker companies over time. In other words, the fund is built to do something very specific, deliver growing income from financially durable businesses. And that design choice matters because a lot of the overrated criticism is really just frustration that SCHD doesn't behave like a high-growth tech fund. But it was never supposed to. It's designed for durability, not excitement. And historically, the strategies that feel the most boring in the moment are often the ones investors actually stick with long enough for compounding to work. Excitement drives headlines. Consistency builds portfolios. Myth number 6, dividends are bad because you pay taxes. This one sounds sophisticated, but it usually lacks context. In taxable accounts, qualified dividends are taxed at long-term capital gains rates. In retirement accounts, Roth IRAs, traditional IRAs, 401ks, dividends are either deferred or completely tax-free. So account type already changes the math significantly. But the bigger point is simple. Dividends are company profits paid to shareholders. Taxes are a result of earning money. Nobody says don't take a salary because income tax exists. Nobody avoids selling a winning stock because of capital gains. But somehow dividends get singled out. The logic doesn't hold. You earned money. You owe some tax. That's not a flaw in the strategy. That's the strategy working. Myth busted. Myth number 7, I can get 12% yield somewhere else. I hear this one a lot. Why settle for SCHD when I can buy something paying 10% or 12%? And yes, high yield absolutely exists. Funds like JEPI, JEPQ, and QYLD are popular for a reason. They can generate meaningful income in the right environment. And to be very clear, those are not bad products. They are different tools designed for different objectives. Here's the key difference most people miss. SCHD's dividend is primarily funded by growing corporate profits from the companies it owns. Many covered call and option income ETFs generate part of their yield by selling upside through options strategies. That can produce attractive income today, but it is a very different income engine than owning businesses that are increasing their payouts over time. Neither is inherently wrong, but they are not interchangeable. A high yield today that doesn't grow is like a raise that never gets another raise. SCHD is built to give you smaller checks now that keep getting bigger. Which one matters more depends entirely on what you're building toward. Myth busted. Myth number 8, you have to pick growth or dividends. Growth versus income, tech versus dividends. Pick a side. It's one of the most exhausting arguments I've ever heard, and it's also one of the least useful. That's not how real portfolios are built, and it's not how I invest. Let me show you what this actually looks like in practice, not hypothetically in my own retirement account. VU is the foundation, broad market exposure, my largest holding. QQQM is the accelerator, high growth upside when that environment runs. And SCHD is the anchor, income, stability, and compounding dividends. None of them win every year. Together, they don't need to. Each one has a job. The portfolio works across different market environments because I'm not asking any single fund to do everything. That's not settling, that's strategy. Myth busted. And one quick thing to keep an eye on, SCHD's annual rebalance is coming up in March. This is where weaker names get removed and stronger dividend growers get added. I'll be breaking down the changes when the new holdings drop, so make sure you're subscribed if you want to see that. Here's the truth. SCHD has lagged before. It will lag again. No strategy wins every year, and anyone telling you otherwise is selling something. But SCHD has a clear job inside a diversified portfolio, and when you actually understand that job, most of the online criticism starts to sound like what it really is. Short-term noise dressed up as math. 8 myths, 8 busted. Your strategy hasn't changed. Your understanding of it just got sharper. If you want to see exactly how much SCHD you'd need to potentially replace a full-time income with dividends, check out this video right here. I think you'll really enjoy it. Don't forget, drop your SCHD count in the comments. Thank you so much for watching. Take care, and I will see you next time.